Since the post-Lehman recession ended, there's only been one stock market rebound as rapid as the recent one, which has propelled US shares up 13% in the past 26 trading days. Now, that past one was in the October recovery after the US flirted with default in 2011. Back then, it turned out to be something of a dead cat bounce, and a big market wobble followed, which left shareholders out of pocket for 3 months. Could something similar happen this time? Well, it certainly seems possible. When markets go up very quickly, they often stop for a breather, particularly if nothing much in the fundamentals has changed to suggest that shares are worth more than investors previously thought. Quite clearly, the latest rise can't continue at this pace. If the market carried on going up at the same rate for a year, it would more than triple. That just isn't going to happen. The question then isn't whether the rise is going to pause for a bit, but when. Now, the relative strength index is one effort to judge this by trying to classify when stocks are overbought or oversold. This white line shows the overbought level, and this white line here down here is the oversold level, and the red line shows the RSI index. Now, the logic's simple enough. When prices rise a long way very quickly, short-term traders become more willing to sell to lock in profits. That makes news more likely to be interpreted negatively because people are already looking for an excuse to get out. The same applies when prices fall rapidly in the other direction. People become more willing to buy. Now, the 14-day RSI is the standard, which I've put here for the S&P 500, and at the moment it's just on the cusp of hitting that overbought level. You can see it's just below it there. It's barely moved so far this morning. It had a bit of up and a down, but it's basically flat at the moment, so no change in the RSI. Now, the RSI isn't science, but it's the sort of jiggery pokery that passes for statistical analysis in markets. It isn't much use as a trading signal, as it can go to really extreme levels from time to time and burn out anyone who tries to use the trading models. The trading models on the RSI usually aim to sell at 75, which is some little way further up still, and to buy in at 25. You can see if you'd bought in there, you would then have had a few days of quite painful losses. In the past, it has fallen as low as 11 in the 1987 crash and after September the 11th attacks in 2001. And it has carried on up past that 75 point to reach as high as 86 in the past. The RSI definitely isn't a good investment signal either. This is all about looking for short-term moves in the market. It's not for those sensible souls who take a 10-year horizon. But it is a useful check that, yes, the market really has gone up a long way very quickly. It only has to carry on a little bit more before it'll be time to start growing concerned about short-term performance once we hit those overbought levels. Now, with the S&P 500 also less than 1% below its previous high, sell signals abound in the short run. The bulls out there, of course, can reassure themselves that this sort of technical analysis is produced in dark rooms by people who spend more time making charts than making money. The bounce is eminently justified by the evaporation of fears that China was setting out on a course of devaluation. But those who suspect that there's a kernel of truth about investor psychology at the heart of the technical indicators really should be thinking that they might want to get ready to start taking profits soon.